Have you ever heard the following phrases? Debt is the root of all evil. Debt will ruin your life. Debt is slavery. Never get into debt. While these are true to an extent, debt can actually be used to generate billions of dollars, which has been proven multiple times. This may make you frustrated since you may have a mortgage on your home, a car loan, or student loans to pay off that makes you feel enslaved to your job. Don't get me wrong, those types of debt are definitely bad. They can make you feel like you're drowning in debt, that you're enslaved to your job. But with the right kind of debt, you too can become a millionaire or even a billionaire. Despite these circumstances, the United States has embraced debt, with consumer debt nearing $15 trillion and the average household debt surpassing $5,300. The U.S. GDP is over $21 trillion in debt, which indicates that most of the U.S. economy consists of debt. Now, you may be wondering, how the heck can debt generate money? The first way to make money with debt is leverage and margin trading. To explain what that is, let me tell you a short story. Once upon a time in the bustling city of Wall Street, there lived an ambitious investor named Alex, who sought to maximize his returns through strategic investing. Intrigued by the concepts of margin and leverage trading, Alex embarked on a journey to explore these powerful strategies. Margin trading allowed Alex to borrow funds from his brokerage to invest in a diversified portfolio, amplifying his buying power. With careful consideration, Alex opened a margin account using a portion of his own funds as collateral. The additional capital provided by the brokerage allowed Alex to make larger investments and potentially achieve higher returns. As Alex dove deeper into margin trading, he discovered the inherent risks involved. Leverage, a key aspect of the strategy, magnified both gains and losses. This meant that even a small market downturn could lead to significant losses that exceeded his initial investment. Recognizing the importance of risk management, Alex developed a disciplined approach. Through diligent research and study, Alex learned to set strict stop-loss orders to limit potential losses. He also used his skills in technical and fundamental analysis to make informed investment decisions. This knowledge empowered him to navigate the volatile markets with greater confidence. Alex's journey was not without challenges. He experienced both exhilarating wins and disheartening losses. However, each setback served as a valuable lesson, reinforcing the importance of disciplined investing and risk management. With perseverance and a commitment to continuous learning, Alex steadily grew his portfolio. Over time, Alex became a beacon of inspiration for others. He shared his experiences, cautioning newcomers about the potential pitfalls of margin trading, while emphasizing the significance of informed decision-making and risk management. Alex's story resonated with many, motivating him to approach investing with a disciplined mindset and a keen awareness of the risks involved. In the end, Alex's journey exemplified the power of margin trading and leverage when approached with caution and sound judgment. Through his determination, Alex achieved success, not only in growing his wealth, but also in imparting valuable knowledge to aspiring investors. The second way billionaires make money with debt is through hedge funds. Hedge funds are designed for the rich to make rich people richer. Normal individuals like you and me tend to invest our hard-earned money into businesses that we support and that we would like to see thrive. But hedge funds have an opposite and rather unethical way of making money. Hedge funds try to make money off companies whose stock price falls or even off businesses that are going bankrupt, like the case with GameStop. But with GameStop, the internet pushed the hedge funds and made them lose $13 billion. Now you may be thinking, how do hedge funds make money with debt? For this example, we will bet against Tesla. Let's say Tesla released a new car model. This new modern model contains state-of-the-art technology that allows it to completely drive itself. Everyone loves the idea of self-driving cars, and the orders start pouring in. Pretty revolutionary, right? One day, one of these cars has an error in their system and accidentally runs over someone. Of course, it would be a tragic event. But you know what else would have happened? The stock price would plummet. Let's do an example of how this would work out. A hedge fund owner would call their stockbroker and ask them if they could borrow Tesla shares worth $100 and then instantly sell it in the open market. The hedge fund owner will then have $100 to put in his pocket. But he would also have to buy back a share at a later date for a cheaper price, and then give back the stock to his stockbroker, and then he would keep the difference. But if the share went up instead, he would have to buy it back more expensively and therefore lose his money. The third way to make money with debt is with bonds. In the vast landscape of financial instruments, bonds stand as a stalwart pillar of stability and income generation. Within the broad world of investments, bonds serve as a cornerstone, offering individuals and institutions a reliable avenue to lend their capital and earn fixed returns. Imagine a world where governments, municipalities, and corporations seek funding to fuel their operations or finance ambitious projects. They turn to the bond market, a place where investors extend a helping hand by purchasing bonds. Bonds, in essence, represent loans provided by investors to these entities in exchange for regular interest payments and the return of their investment. At its core, a bond is a contractual agreement binding the issuer and the investor in a mutually beneficial financial relationship. The issuer, which may be a government or a corporation, promises to repay the borrowed amount, known as the principal, on a specified maturity date. In the meantime, the investor receives periodic interest payments, often referred to as coupon payments, at a fixed or floating rate. The beauty of bonds is that they are relatively stable compared to other investments. They offer a predictable income stream and are generally considered lower risk instruments when compared to stocks or other volatile assets. This characteristic makes bonds particularly attractive to risk-averse individuals or those seeking to diversify their investment portfolios. Bonds exhibit a broad spectrum of types and categories, each with its unique features. Government bonds issued by sovereign nations are often regarded as the safest, as they benefit from the financial backing and stability of the issuing government. Corporate bonds, on the other hand, are issued by companies seeking capital for various business activities, carrying a slightly higher risk profile, but often accompanied by higher yields. Municipal bonds serve as a means for local governments to fund public projects such as infrastructure development or educational initiatives. These bonds offer tax advantages to investors and contribute to the betterment of local communities. Additionally, there are specialized bonds such as convertible bonds or zero-coupon bonds, each catering to specific investor preferences and risk appetites. Bond investing requires careful consideration of factors such as credit quality, interest rate environment, and the issuer's financial health. Investors weigh these elements to assess the risk-reward profile of a bond, aiming to strike a balance between income generation and capital preservation. In summary, bonds embody the essence of stability, offering investors a fixed income stream while supporting the growth and development of governments, municipalities, and corporations. They serve a vital component of investment portfolios, providing diversification and income generation. Through bonds, investors participate in the cycle of lending and borrowing that fuels economic growth while reaping the rewards of consistent returns. The fourth way is with forex trading. In the world of finance, the foreign exchange market, or forex, serves as a dynamic platform for buying and selling currencies. It offers individuals, institutions, and central banks the opportunity to profit from currency fluctuations. One key feature of forex is leverage, a tool that allows traders to control larger positions with a smaller amount of capital. Leverage ratios can reach as high as 100 to 1, meaning that for every dollar invested, traders can control $100 in the market. Leverage at forex is made possible through margin trading. Traders deposit a fraction of the total trade value, known as the margin, while the remaining amount is borrowed from the broker. This enables traders to amplify potential profits or losses. For instance, with 100-to-1 leverage, an investor with $1,000 can control a trading position worth $100,000. However, it's important to understand that while leverage can enhance returns, it can also increase risk. Traders must be mindful of the potential for losses as market movements against their position can erode their invested capital. Forex trading necessitates a comprehensive grasp of market dynamics, adept risk management, and analysis of economic indicators and geopolitical events. Traders employ strategies like technical and fundamental analysis to forecast currency movements and make informed decisions. Risk management techniques are critical when leveraging positions in Forex. Traders often use stop-loss orders and establish risk-to-reward ratios to protect their investments and limit potential losses. In summary, Forex provides an avenue for trading currencies globally. Leverage empowers traders to control larger positions with less capital, but it also intensifies risk. Success in Forex requires market knowledge, analytical skills, and disciplined decision-making to navigate currency fluctuations and seize opportunities. The fifth and final way is the best one yet, and it's called refinancing. Real estate debt is the best kind of debt since there are a lot of loopholes, and if you don't have a mortgage, you're essentially just paying extra taxes. This is why rich people tend to have multiple mortgages so they can avoid taxes. Think of it this way. Every dollar that you pay in taxes is an extra dollar that you could save, use, or invest elsewhere. Now, let me tell you how rich people get richer in real estate. In this particular case, let's imagine that you saved $150,000. That might seem like a lot of money, but in reality, you can't even buy a house with that amount. But you can get a mortgage up to $600,000 since you have to make a 20% down payment. But here is the beauty of real estate debt. Let's say you find a house that is completely run down, but it is located in the middle of a beautiful neighborhood. This property is valued at $500,000 while the nice houses around it are valued at $750,000. So you walk into a bank and take out a loan of $500,000 and you put down 20%, which is $100,000. You then buy the home and renovate it. Let's say the renovation cost is $50,000. You then go back to the bank and refinance your mortgage. When you took out the first mortgage, the value of the house was $500,000. But now that you have renovated it, it is worth $750,000. Like the first mortgage, let's say you're going to get an 80% mortgage. 80% of $750,000 is $600,000. $400,000 out of that is going to pay off the first mortgage, and $50,000 is going towards the repair costs. You're now left with $150,000 in profit that you can put in your pocket, plus a piece of real estate that you can rent out and make passive income out of. So the next time you hear someone say debt is slavery or debt is the root of all evil, remind them that rich people use debt to grow their wealth, and that it is important to understand what good debt and bad debt is.